Extreme Money, Full Audiobook Style Summary by Satyajit. Das Part 1, The Author and the World That Shaped Him. Chapter 1, Who is Satyajit Das? Narrator, measured steady. To understand Extreme Money, you must first understand the man who wrote it. Satyajit Das is not merely a financial commentator looking from the outside in. He is a veteran who has lived in the bloodstream of the global financial system. Born in India and raised in Australia, Das grew up in a world straddling two very different economies, one still emerging, the other industrialized and integrated into global markets. This dual perspective would later give him a unique vantage point from which to observe the financial world's excesses. In the 1970s and 1980s, Das began his career in banking with Citibank and Merrill Lynch, where he immersed himself in the rapidly developing world of derivatives. It was an era when financial innovation was gathering momentum. The seeds of securitization, futures markets, and complex options pricing models were being planted. For a young finance professional, it was like standing at the frontier of a new world, one part science, one part magic. But unlike many of his contemporaries, Das was not entirely seduced by the glitter of the industry. He had a healthy skepticism. While others marveled at how financial engineering could create value out of nothing, Das quietly asked, "But what happens when the magic trick fails?" His career took him into treasury management at TNT, one of the world's largest logistics companies at the time. There, he dealt with the practical realities of corporate finance, cash flow, debt management, risk assessment. It gave him a perspective far beyond the trading floor. He saw how financial decisions affected real businesses, real jobs, and real people. By the late 1990s, Das was consulting for banks, corporations, and even government agencies. His expertise in derivatives made him a sought-after advisor. Yet it also made him increasingly concerned. He noticed a growing gap between the complexity of the products being sold and the understanding of those who were buying them. The risks were multiplying, but the safeguards were not. In 2006, 2 years before the global financial crisis, Das published Traders, Guns, and Money, a sharp, witty exposé of the derivatives market. It was equal parts insider confession and warning shot. Readers laughed at his colorful stories of trading floor antics, but the subtext was deadly serious. The system was unstable, the incentives were perverse, and the danger was growing. Then came 2008, the collapse of Lehman Brothers, the freezing of credit markets, the wave of government bailouts. All the chaos that Das had warned about unfolded in real time. Far from gloating, he doubled down on his mission to explain to the public how finance really worked. In interviews, speeches, and essays, he sought to cut through the jargon to show that finance was not an impenetrable black box. It was a man-made machine, and like all machines, it could fail. It was in this post-crisis environment that Das wrote Extreme Money, a book that was not just about the crash, but about the decades-long journey that led us there. To read Extreme Money is to take a guided tour with a man who knows the corridors of Wall Street and the boardrooms of central banks, and who is unafraid to point out the cracks in the marble. Chapter 2, The Financial World, Before Extreme Money. To truly grasp what Das calls extreme money, you must first understand the financial world as it stood before this era. In the simplest terms, money once had a relatively stable definition. It was a medium of exchange, a way to trade goods and services. In ancient times, its value was tied directly to physical reality. Over centuries, paper money emerged, first as a claim on physical goods, later as a standalone symbol of value. This was the first great abstraction, a piece of paper backed by a promise. When the gold standard was abandoned in the 20th century, money became untethered from anything physical. Its value was whatever government said it was, and whatever markets believed it to be. In the second half of the 20th century, a second great abstraction took place. Banks and financial institutions began creating complex products that represented claims not on physical goods, but on other financial instruments. A bond was a claim on future payments. A derivative was a claim on the value of that bond. A synthetic derivative was a claim on the derivative itself. Layers upon layers of promises stacked high. This was financialization, a shift in which financial markets, financial institutions, and financial motives became dominant forces in the economy. By the late 20th century, the financial sector was no longer just a servant to the real economy. It was the master. In this world, the size of the global derivatives market ballooned to many times the size of the world's actual GDP. Corporate profits increasingly came from trading and speculation, rather than from producing goods or services. Debt became the fuel for growth, not just for companies, but for entire nations. It was also an era of deregulation. In the United States, the repeal of the Glass-Steagall Act allowed commercial banks to merge with investment banks, creating financial behemoths that were too big to fail. In Europe, financial markets integrated across borders, enabling massive cross-border capital flows. In Asia, emerging economies liberalized their markets, inviting in torrents of speculative capital. Technology supercharged this transformation. Trading floors that once echoed with the shouts of brokers were replaced by silent rooms filled with blinking screens and algorithms that could execute thousands of trades in milliseconds. High-frequency trading turned markets into arenas where speed was as important as insight. This was the world into which extreme money was born, a world in which money had become faster, more abstract, more disconnected from physical reality than ever before. It was a world in which finance had not only escaped the bounds of the real economy, it had begun to reshape it in its own image. Das saw this and gave it a name, extreme money. And like anything taken to extremes, it carried within it the seeds of its own destruction. Chapter 3. Hubris, the Age of Financial Arrogance. Hubris. In Greek tragedy, it is the overweening pride that blinds a hero to his own limits and ultimately brings about his downfall. In Extreme Money, Satyajit Das applies the same concept to the financial world. He paints a picture of a system intoxicated by its own success, driven by an almost religious belief that the market was not just efficient, but infallible. The late 20th century into the early 21st was the golden age of financial confidence. Decades of relative stability after World War II had convinced bankers, policymakers, and investors that crises were a thing of the past, mere bumps in an otherwise upward trajectory. Inflation had been tamed in the 1980s. Recessions had grown milder. Central banks, armed with interest rate controls and quantitative tools, were seen as omnipotent referees of the economy. In this environment, financial institutions began to think of themselves as engineers of growth. capable of designing prosperity out of thin air. The rise of derivatives markets in the 1980s and 1990s was hailed as a triumph of human ingenuity. Complex mathematical models, many derived from physics and advanced statistics, promised to measure and manage risk with surgical precision. But behind the sleek formulas and glossy presentations lay a dangerous assumption that the past was a reliable guide to the future. Risk models like value at risk, VAR, used historical data to predict potential losses, but they were blind to events outside the historical record, the so-called black swans. When markets were calm, the models reassured traders that risks were minimal. This encouraged ever greater leverage, borrowing more money to make larger bets. By the early 2000s, investment banks were leveraged at ratios of 30-1 or higher. This meant that a mere 3% drop in the value of their assets could wipe them out completely. And yet, inside these institutions, there was little fear. The culture celebrated boldness and innovation, not caution. The masters of the universe, a term borrowed from Tom Wolfe's Bonfire of the Vanities, became the icons of the age. Hedge fund managers, proprietary traders, and investment bankers earned salaries and bonuses that dwarfed those of CEOs in other industries. Their lifestyle was a visible display of financial power. Manhattan penthouses, private jets, art collections worth tens of millions. Success reinforced confidence. A profitable year was seen not as the product of favorable market conditions, but as proof of personal genius. When a bet paid off, it was skill. When it failed, it was bad luck or an unforeseeable event. This selective memory allowed risk-taking to escalate unchecked. One of the most striking examples Das discusses is the long-term capital management, LTCM fiasco of 1998. LTCM was run by a team of brilliant traders, including Nobel Prize-winning economists. Their models predicted that certain market spreads would converge with near certainty. For years, they were right, and the profits were spectacular. But when Russia defaulted on its debt and markets panicked, the spreads moved in the opposite direction. In a matter of weeks, LTCM lost billions and had to be rescued by a consortium of banks under the supervision of the Federal Reserve. The LTCM crisis should have been a wake-up call, a warning that even the most sophisticated models could be blindsided by unexpected events. Instead, it was treated as an anomaly. The hubris persisted. Das emphasizes that hubris is not just an individual flaw, it's a systemic one. Financial institutions are structured to reward short-term gains, even if they create long-term risks. Traders and executives earn bonuses based on yearly performance, but if their strategies blow up years later, the losses are borne by shareholders, taxpayers, or the economy at large. This misalignment of incentives created what economists call moral hazard, the tendency to take greater risks when someone else bears the consequences. The implicit guarantee that large institutions would be bailed out in a crisis only deepened this moral hazard. If you believe you're too big to fail, you act accordingly. In the run-up to the 2008 crisis, hubris was everywhere. Mortgage-backed securities were sold as virtually risk-free because they were backed by American homes, an asset class that always goes up. Collateralized debt obligations, CDOs, were given A ratings by agencies that relied on flawed models and, in some cases, conflicts of interest. The global appetite for yield meant that banks could sell almost any structured product they created. Hubris blinds you to limits. It convinces you that the rules don't apply to you, that the past decade of gains will stretch into infinity. But in finance, as in life, gravity always reasserts itself, and when it does, the fall is swift and unforgiving. Chapter 4. Faith, the invisible currency of finance. Faith. It is not a word one usually associates with balance sheets, risk models, and market indices, and yet Satyajit Das makes it clear. Without faith, the financial system would collapse overnight. Money itself is faith. A paper bill has no intrinsic value. It is a promise, an agreement between all of us that it can be exchanged for goods and services. The same is true of numbers on a bank statement or the balance displayed in an online brokerage account, but these are not tangible assets. They are entries in a ledger, representations of value that only function because we believe in them. Faith is also what keeps markets functioning. When you buy a stock, you believe that the company behind it will continue to operate, generate profits, and honor its obligations. When a bank accepts a deposit, it believes that it can lend most of that money out and still have enough to repay you when you withdraw it. When a government issues bonds, investors buy them because they have faith the government will repay them in the future, often decades later. But in the age of extreme money, this faith extended far beyond the fundamentals. Investors began to place their trust in complex instruments they did not understand, created by institutions they could not monitor, regulated by agencies that were often compromised or under-resourced. This wasn't just faith, it was blind faith. Consider the ratings agencies. Moody's, Standard & Poor's, and Fitch were entrusted with assessing the safety of bonds and structured products. Their 8AA rating was a seal of security, a signal to investors that a given instrument was as safe as U.S. Treasury bonds. Pension funds, insurance companies, and municipalities relied on these ratings when making investment decisions. But as Das notes, these ratings were often based on flawed models that underestimated the likelihood of default. Worse, the agencies were paid by the very institutions whose products they rated. A conflict of interest so glaring that, in hindsight, it seems absurd it was ever allowed. Faith also manifested in the trust placed in central banks. Throughout the 1990s and early 2000s, the Federal Reserve, under Alan Greenspan, cultivated the image of a steady hand on the tiller. Greenspan's interventions during the 1987 stock market crash, the 1994 bond market turbulence, the 1997 Asian financial crisis, and the 1998 LTCM collapse all reinforced the belief that the Fed could and would step in to stabilize markets whenever needed. This became known as the Greenspan put, a term borrowed from options trading, where a put option protects the holder from losses if a stock falls below a certain price. In essence, investors believed that if things went badly, the Fed would lower interest rates or inject liquidity to prop up asset prices. This belief encouraged risk-taking, as market participants assumed they would be rescued from the worst consequences of their actions. In Extreme Money, Das draws a striking parallel between financial faith and religious belief. In both, there is an acceptance of truths that cannot be proven in the moment. Investors do not demand to see a company's future earnings. They accept projections and forward guidance. Bondholders do not require governments to prove they can repay their debts decades hence. They trust in the continuity of the state. But faith can be fickle. When confidence is shaken, it can evaporate in an instant. The run on Northern Rock in 2007 is a prime example. For years, British depositors had trusted the bank with their savings. But when whispers of trouble began, concerns about the bank's funding model and exposure to U.S. mortgage markets, customers queued outside branches to withdraw their money. In a matter of days, the faith that had taken decades to build was gone. Das warns that the entire financial system is a pyramid of faith. At the base is the belief in the stability of governments and currencies. Above that is the faith in banks and financial institutions. Higher still is the trust in complex financial instruments, each resting on the stability of the layers below. If the base weakens, if faith in governments, currencies, or major institutions falters, the entire structure is at risk. This fragility is what makes extreme money so dangerous. When confidence is high, the system hums along, appearing invincible. But when doubt sets in, the speed and scale of collapse can be breathtaking. Chapter 5. Fundamentalism, when markets become a religion. In the previous chapter, we explored faith as the invisible glue holding the financial system together. But faith alone is fluid. It can waver. It can change. Fundamentalism, on the other hand, is faith hardened into doctrine. It is belief that has closed itself off to doubt. And in extreme money, Satyajit Das warns that the modern financial system has been gripped by its own economic fundamentalism. At its core, this fundamentalism is built on a handful of tenets treated as sacred truths. Markets are efficient. Prices reflect all available information. Risk can be quantified and managed. With the right models, nothing is truly uncertain. Growth is always good. The economy should expand endlessly, and finance is the engine that drives it. Leverage is a tool for progress. Borrowing to invest is not only acceptable, it is the key to amplifying returns. Financial innovation is inherently beneficial. New products, new markets, and new strategies are assumed to improve the system. These ideas were not always dogma. They emerged gradually, gaining traction in academic circles, in the policy-making arena, and on trading floors. But by the 1990s, they had become so entrenched that questioning them was akin to heresy. One of the pillars of this belief system was the efficient market hypothesis, EMH, popularized by economist Eugene Fama. EMH argued that markets are so good at processing information that asset prices always reflect true value. If this were strictly true, bubbles and crashes would be impossible. Yet history is filled with examples: tulip mania, the South Sea bubble, the dot-com bust, that prove otherwise. Still, EMH was embraced, not because it was infallible, but because it gave market participants a comforting sense of order and predictability. Another cornerstone was the belief that risk could be fully modeled and managed. This led to the development of intricate quantitative systems, like black skulls for options pricing and value at risk for portfolio exposure. These tools were powerful, but they were also brittle. They assumed that the world behaved according to neat statistical distributions, when in reality, markets are subject to wild, unpredictable swings. Das points out that fundamentalism doesn't just blind you to risks. It actively encourages you to ignore them. In the pre-2008 years, many banks were loading up on mortgage-backed securities and complex derivatives because their models showed minuscule probabilities of default. To question those models was to question the prevailing orthodoxy. In some institutions, raising such doubts could stall a career. Then there was the doctrine of perpetual growth. The idea that GDP must always increase is so embedded in modern economics that few stop to consider its feasibility. In nature, nothing grows forever without consequence. Trees stop at a certain height. Populations reach carrying capacity. Yet the financial world clings to the idea that economies can and must expand infinitely, often by using debt to pull future consumption into the present. This debt-fueled growth became the cornerstone of the cult of risk, another phrase Das uses to capture the almost spiritual reverence for leverage. Borrowing wasn't just tolerated, it was celebrated as a sign of ambition and vision. Private equity firms would acquire companies using enormous amounts of borrowed money, strip costs, and then sell at a profit, all under the assumption that markets would remain favorable. Financial innovation was treated with similar reverence. The introduction of credit default swaps, CDS, collateralized debt obligations, CDOs, and synthetic derivatives was seen as proof of the industry's genius. These products allowed risks to be repackaged, resold, and ostensibly spread across the system. In theory, this diversification made the system safer. In reality, it created complex webs of interconnected liabilities so that when one part of the system failed, the damage rippled everywhere. Fundamentalism in finance operates much like religious dogma. It resists empirical challenge, it dismisses dissenters, and it perpetuates itself through institutions, education, and culture. Business schools teach the same core assumptions to each new generation of traders, analysts, and executives. Policy debates are framed within the boundaries of accepted doctrine, and media coverage often reinforces rather than questions the underlying beliefs. The danger of such fundamentalism is not just that it blinds the system to flaws, it actively amplifies those flaws. When everyone believes the same thing, they make the same bets, take the same risks, and ignore the same warning signs. This herd behavior magnifies bubbles and deepens crashes. Das's message is clear. When markets become a religion, they lose the ability to self-correct. Instead, they march unblinking toward the next crisis. Chapter 8. The Rise of Structured Products. Complexity. Wrapped in confidence. Structured products, as Satyajit Das explains, are the Swiss Army knives of modern finance, except instead of corkscrews and scissors, they contain interest rate swaps, credit default swaps, equity options, and sometimes enough leverage to make a seasoned banker sweat. These instruments were marketed as tailor-made solutions for investors. Need a product that pays a fixed income unless the yen moves more than 10%? Done. Want exposure to commodities without actually holding any physical oil or wheat? Easy. The beauty and danger of structured products is that they allow financial engineers to slice and dice risks into shapes that no one had seen before. They take underlying assets, wrap them in derivatives, and create a new product entirely. To a client, it seems like bespoke risk management. To the bank, it's a high-margin business that often hides complexity. Das likens it to giving someone a high-performance sports car with a complex dashboard. the customer feels in control, but under the hood, the mechanics are working at speeds the driver doesn't understand. The story of these products is also a story of seduction. In the pre-2008 era, many pension funds, municipalities, and even small investors bought structured products because they promised slightly higher returns than safe bonds. That slight improvement often masked dramatically higher risks. In one of his sharpest critiques, Days dives into the infamous credit default swap, CDS, a contract that functions like insurance against a borrower's default. But here's the twist. Unlike traditional insurance, you don't have to own the underlying asset to buy protection. You can bet on the failure of a company or a country without ever lending them a cent. This creates a peculiar moral hazard. Imagine you could buy fire insurance on your neighbor's house without their knowledge, and you don't even live nearby. Suddenly, you have a financial incentive for the house to burn down. Das explains how, in the run-up to 2008, CDS became a multi-trillion-dollar market. Hedge funds, banks, and even AIG, the insurance giant, sold enormous amounts of protection, assuming defaults. But when the financial crisis hit, those rare events became common, and the insurance sellers faced catastrophic losses. The CDS market illustrated one of Das's recurring themes. The financial system can take a sound idea, scale it massively, remove its natural limits, and transform it into a systemic risk. Chapter 10. The Shadow Banking System. Banking without the safety net. Das's narrative then shifts to the world of shadow banking, a term that sounds sinister because, frankly, it is. Shadow banking includes hedge funds, money market funds, investment vehicles, and any financial operation that performs bank-like functions without being regulated as a bank. Banks are heavily regulated because their collapse can trigger a chain reaction. They must hold reserves, undergo audits, and follow strict lending rules. Shadow banks, on the other hand, operate with far fewer constraints. The irony, Das notes, is that shadow banks became a parallel financial system so large that when they faced trouble, governments had to rescue them anyway, because letting them fail would have destroyed the entire economy. The collapse of Lehman Brothers, the freezing of money market funds, and the near failure of giant insurers like AIG showed that risk had simply migrated outside the traditional banking system, where it grew unchecked. Chapter 11. The Age of Liquidity. When money becomes a deluge. The modern financial system runs on liquidity, the ability to buy and sell assets quickly without drastically changing their price. In good times, liquidity seems infinite. In bad times, it vanishes like water in the desert. Das compares this to a crowded theater. Everyone can enter easily, but if someone shouts fire, the rush for the exit reveals the doors are far too small. Central banks, particularly the Federal Reserve, have become the ultimate providers of liquidity, stepping in during crises to flood markets with money. While this prevents immediate collapse, it also creates long-term dependency. Investors begin to believe central banks will always step in to protect asset prices, the so-called Fed put. This belief encourages risk-taking, inflates asset bubbles, and turns every market dip into a buying opportunity, until one day the system faces a shock even central banks can't absorb. Chapter 12. The Crisis. When extreme money meets extreme consequences. The 2008 financial crisis is where all the threads of extreme money converge. Das walks us step by step through the build-up. Cheap money from central banks after the 2000 dot-com crash. Complex structured products that hid leverage and risk. CDS and derivatives that spread exposure throughout the system. Shadow banking that grew massive without safety nets. The result was a fragile system that collapsed when U.S. housing prices fell. Mortgage-backed securities plummeted in value, structured products became worthless, and CDS payouts bankrupted firms like AIG. Liquidity evaporated. Interbank lending froze. Governments had to step in with trillions of dollars in bailouts. Das emphasizes that while 2008 was triggered by housing, the root cause was deeper, a financial system addicted to complexity, leverage, and ever-increasing speed. Part 8. The Financial Engineering Arms Race. By the late 1990s, financial innovation had shifted into an overdrive that few could truly comprehend. In the past, markets had evolved to meet clear needs: hedging risk, raising capital, enabling trade. But now, products were being invented simply because they could be, like a chef cooking exotic dishes nobody had asked for. The rise of synthetic finance. Satyajit Das uses the term synthetic to describe how finance began creating products that mimic the behavior of real things, but without actually involving the real things. Instead of lending money to someone and earning interest, banks created securities that behaved as if loans existed. Instead of buying actual bonds, traders could buy derivatives that replicated their returns. This meant that finance could grow detached from the real economy entirely, becoming an elaborate mirror of a mirror. Competition among banks intensified this innovation race. If one bank offered a slightly better yield on a structured product, rivals would quickly copy and tweak it. Traders were rewarded for short-term profits, not long-term stability, and the complexity of deals was often a selling point, making it harder for clients to see the risks. Part 9. The Illusion of Safety. Perhaps the most dangerous part of this era was the belief that financial engineering had made risk vanish. Banks and investors placed their faith in value at risk. VAR models, stress testing, and credit ratings, thinking these could predict and control extreme events. In reality, the models were based on historical data and assumptions that markets behaved in normal ways. They couldn't foresee rare, catastrophic events. The black swans. Das points out that risk wasn't eliminated. It was simply transferred. When big banks sold risk to other institutions, they assumed those institutions could handle it. But in truth, the same small pool of investors often ended up holding the same kinds of risky assets, magnifying systemic danger. Part 10. The Shadow Banking System. The early 2000s saw the emergence of a financial system that operated outside traditional banking regulations, the shadow banking sector. This included hedge funds, money market funds, special investment vehicles, SIVs, and other entities that didn't take deposits but still engaged in lending and investing. The problem? They had no safety net like the FDIC or central bank backing, yet they were deeply connected to the regulated banking system. Banks use shadow banks to move risky assets off their balance sheets, making themselves look healthier while still being exposed to the underlying danger. Part 11. Leverage on steroids. Das reminds us that leverage is a double-edged sword. It magnifies profits in good times, but devastates balance sheets when markets fall. By the mid-2000s, many banks were leveraged at 30 to 1, meaning a mere 3% drop in asset value could wipe them out. Households, too, were heavily leveraged through mortgages, credit cards, and home equity loans. And yet, few worried. House prices had never fallen nationwide in the U.S., so it was assumed they never would. That assumption would prove fatal. Part 12. Prelude to the Global Financial Crisis. Satyajit Das describes the pre-2007 atmosphere as one of manic optimism. The financial world had convinced itself that the combination of derivatives, global capital flows, and central bank intervention meant recessions were a thing of the past. This belief was known as the Great Moderation. The problem? The system was built on cheap credit, endless refinancing, and faith in liquidity. If credit froze or confidence cracked, the whole edifice could crumble. And in 2007, cracks began to appear in the U.S. subprime mortgage market, the first domino in a chain that would trigger the most severe financial crisis since the Great Depression. Chapter 8. Debt, the Dangerous Game. Das's critique of modern debt culture is one of the most forceful parts of extreme money. He argues that debt has transformed from a tool for funding productive investments into a high-stakes casino where borrowers and lenders alike gamble on the future. Historically, debt was tied to tangible outcomes, financing railways, factories, or infrastructure that would generate real returns. But in the modern era, debt is increasingly used to finance consumption, asset speculation, and even the refinancing of other debts. 1. The illusion of affordability. Debt seduces borrowers by offering instant gratification at the cost of future income. For households, this has meant credit cards, mortgages, and personal loans that create the illusion of prosperity while locking families into decades of repayment. For corporations, it often means issuing bonds or leveraging balance sheets to fund stock buybacks rather than innovation. 2. Sovereign debt and the global web. Governments, too, have embraced debt as a political tool, financing welfare programs, military spending, and infrastructure without raising taxes. This creates the political illusion of generosity and competence while pushing the costs into the future. Das points out that sovereign debt markets are deeply interconnected. A crisis in one nation can ripple across the globe, as seen in the Eurozone debt crisis. 3. Debt as a financial weapon. In an era of financial engineering, debt is not just borrowed. It's packaged, sliced, and sold. Collateralized debt obligations, CDOs, leveraged loans, and other structured products turn debt into a speculative asset class in its own right. Das warns that this process removes debt from its human and economic consequences, turning it into a game of numbers for traders and institutions. 4. The problem of moral hazard. Perhaps most troubling, modern debt markets often shield lenders and borrowers from the full consequences of their actions. Bailouts, loan forgiveness programs, and central bank interventions create a heads I win, tails you lose dynamic, encouraging reckless behavior. Das likens this to allowing gamblers to keep their winnings while the house covers their losses, unsustainable in the long run. Part 10. Final Reflections. What Extreme Money Means for the Future, As Extreme Money nears its close, Satyajit Das steps back from the detailed mechanics of financial excess and asks the most important question: where do we go from here? He warns that the financial system is unlikely to voluntarily reform itself. The incentives are still skewed toward risk-taking, short-term profits, and complex products that generate fees for the middlemen rather than value for society. In essence, the same forces that created the 2008 crisis remain in place, only now they are cloaked in new rhetoric about stability, regulation, and innovation. The persistence of leverage Das stresses that leverage, using borrowed money to magnify returns, remains the most dangerous drug in the financial world. Even after the global financial crisis, governments and central banks encouraged more borrowing to stimulate economic growth. This creates a paradox. The medicine used to treat the illness is the same substance that caused it. He likens this to feeding an alcoholic whiskey to steady their nerves. In the short term, it calms the symptoms. In the long term, it worsens the addiction. The social cost of extreme money. One of the book's more sobering messages is that the burden of financial recklessness is rarely borne by those who cause it. When complex derivatives, speculative bubbles, and over-leveraged institutions collapse, the costs are shifted onto taxpayers, workers, and savers. Das frames it as a moral hazard on a societal scale. If risk-takers know they will be rescued, they have no real reason to change their behavior. The system remains locked in a dangerous cycle of privatizing profits and socializing losses. The psychological roots money is not just an economic tool, it is also an emotional and psychological construct. Das digs into human nature, greed, fear, status-seeking, and the seductive belief that this time is different. He shows how these forces drive market manias, regardless of whether the financial environment is 1929, 2000, or 2008. He notes that extreme money is not a purely modern phenomenon. History is littered with tulip manias, South Sea bubbles, and speculative frenzies. The only difference today is that technology, global interconnectedness, and financial engineering have amplified the scale and speed of both gains and collapses. The warning to policymakers does ends with a challenge to governments, regulators, and central banks. Tame the system before it tames you. He argues that half measures and political compromises will not be enough to prevent another crisis. The changes needed, breaking up too-big-to-fail banks, enforcing strict capital requirements, banning opaque products, are politically difficult because of lobbying, vested interests, and fear of disrupting markets. But without structural reform, Das predicts we are destined to repeat history. Only the form of the next crisis will change. The underlying dynamics will remain the same. Closing thought. In the final pages, Satyajit Das drives home the central message of extreme money. Finance is a mirror. It reflects our values, our fears, and our ambitions. If we do not like the reflection, we must change what it is showing. The book closes not with a promise of easy solutions, but with a sober recognition that the financial system is an expression of human behavior itself. And as long as we worship speed, leverage, and profit without regard for stability, we will always be living with the risk of the next collapse.